It's been a good year for the markets, and September's been okay as well. That's despite challenges, including Trump's tariff war, high stock valuations, and lingering inflation worries. Starting tomorrow, though, another hurdle is emerging, with a U.S. government shutdown appearing imminent. The vice president has confirmed that the U.S. administration is headed in that direction after failing to strike a deal with the Democrats. Let's unpack all this with Adam Turnquist, Chief Technical Strategist at LPL Financial. Adam, great to see you. Thanks for joining us.
Hey, good morning. Thanks for having me on.
Start off with this government shutdown. They go through this ritual, this theater every few years. Is it a threat to the market, do you think?
Historically, it has not been. When you look back the last 50 years, there's been about 20 U.S. government shutdowns. The average duration of those shutdowns, only 8 days. So the fact that they're pretty short-lived, they tend to have a pretty minimal impact on the economy and markets. Even over those 20 shutdowns, I think the average return, for example, on the S&P 500 has been basically flat. And I think the big threat right now is just on a shorter term basis. Are we going to get that payrolls data on Friday? The market's highly anticipating getting that new update on the employment situation here in the U.S. We'll see if that comes out on Friday. If there is a shutdown, don't expect it, though.
You reckon there are plenty of factors likely to keep this bull market alive. List one or two of them, if you would.
Well, let's talk about corporate America. When you look at the S&P 500, the earnings story there, certainly resilient. We got double-digit earnings growth last quarter, probably similar type returns for the S&P in terms of earnings growth this quarter. Margins are expanding to near record levels, and even next year's numbers look pretty good. And it's not just the mega cap names, although they're doing most of the heavy lifting here on the earnings growth. It has broadened out, so that's been a really good story. And then, of course, the Fed, the rate cutting cycle resumes. Throughout history, when the Fed is cutting rates, when stocks are at or near record highs, it's usually a pretty good sign. It certainly helps offset maybe some slowdowns in the labor market and potentially just some slowdowns at the consumer level as well.
Though you do see some evidence of internal S&P 500 trends weakening. Now, talk about the downtrends versus the uptrends. I think we have a chart.
Yeah, I think the simple way to frame this up, we see in the market right now maybe some room for short-term pain, but still long-term gains. When you look at the market on that shorter-term basis, arguably overbought. The S&P just hit about an 11% premium above its 200-day moving average. And what stood out really from a technical level is just the market internals. How many stocks are actually pushing the market higher? On this latest leg higher for the S&P, it's been fewer and fewer stocks. The trends within the index, we have a proprietary trend model that we look at, have actually deteriorated, especially in the tech sector. We had 80% of the tech sector back in August in a strong uptrend. We're down to about 50% right now, which is a little concerning when that sector is about a third of the S&P 500.
But nevertheless, you don't see this as enough of a threat to actually stop the bull market for now.
No, we think it's probably time for a breather. No surprise there. When you look at a 30+% rally since April, we've had very limited drawdowns in this market. There has been very few, 1-2% down days. So we do think there's room here for a breather. If we start breaking below a support level that we look at around 6,500, maybe that opens the door for a retest of the February highs on the S&P 500 around 6144. So that's that type of pullback in terms of percentage terms, completely normal within the context of a bull market. And look, I think it would be a positive for the bull market. You have fundamentals, get a chance to catch up with price, you reset some of those overbought conditions, and then for investors out there, potentially a great opportunity to buy the dip.
What about the AI joy, euphoria, optimism? Is it too much? I mean, is there just too much spending planned?
It just hasn't slowed down. When you hear about 4 companies putting up, $300 billion, $400 billion in capex on AI next year, you have CEO of Jensen Huang, NVIDIA CEO, talking about that number could be $600 billion. I think the big question for AI, and maybe this is a 2026 story, is what's the return on investment and all this spending? Maybe that's the slowdown point when and if the numbers aren't as high as maybe assumed right now, given some of the valuations in that space.
Adam, your base case for the U.S. economy is that a recession is not likely.
No, right now we think for this year, maybe growth of around 1.5% in terms of our real GDP forecasts. We think that's supported again by the Fed reinstating that rate cutting cycle. That should help, really on the downside of growth. We still have a decent labor market. It's slowed down, down to 29,000 jobs per month. But when you look at the unemployment rate at 4.3%, that has been pretty stable. It's inched higher, but not to an area that is really signaling any type of a recession leg. The jobless claims data has been pretty solid as well. We do think the consumer is slowing down a little bit after a remarkable run coming out of the pandemic. Maybe normalizing is a better term there, but still that higher end consumer still spending, still in pretty good shape. And real wages are actually outpacing inflation right now. And that's been a big part of that resilient consumer story. So we think we can skate by without a recession. We acknowledge that recession risks have incrementally moved higher, just given some of the tariff news and the slowdown in the labor market, but we think we'll be able to, we'll call it muddle through the rest of this year and into next year.
What's your view on interest rate sensitives? I'm thinking not talking of specific stocks, but maybe we can put up a 5-year chart for Toll Brothers as a representative of the home builders. Obviously, they are partly dependent on bond yields because they influence mortgage rates. So say sorry, go ahead.
Yeah, so for interest rates right now, we think more of a consolidation phase is really the best scenario for the broader market. When you look at lower yields, I think you have to be careful what you wish for. There's this idea that, look, the market needs lower yields to continue moving higher, but there's a tipping point when you look at, for example, the 10-year yield. I think if we start breaking below 4%, that's really the market pricing in higher recession risks. So the fact that we can move sideways in the rate market, I think, is probably, again, the best case scenario for equity markets. We do think the long end is being pushed higher by a higher term premium. Simply, investors are demanding more yield to take on duration risk. And then global yields right now are pushing the long end higher as well. Areas like Germany, Japan, really across most sovereign rates, they're all moving higher. So that's having a little bit of a pull. But the fact that we're reinstating that rate cutting cycle does contain some of that long end pressure. So we do think it's more of a range bound setup for yields into year end.
The financials, the big US banks, the JP Morgans and the Citi, without commenting on the specific stocks, what about them? Are they a good place to put money right now?
Yeah, we like the financial sector, especially the banks. Some of the areas outside of the banks not doing so well, but in the banking space, they've done great. We have a steepening yield curve. We think there's room for that curve to continue steepening. That typically helps net interest margins in the banking space. When you look at their credit profile in terms of loan loss provisions, it's been pretty good. And then, especially on those big banks, they're making a lot of money trading. It's been a relatively volatile year, especially in the first quarter. We think those trading revenues could be pretty stable in a big support for the banking space into year end.
And what about the classic consumer stocks? I'm thinking about a McDonald's or even a Starbucks. I know they all have idiosyncrasies, but do you think the consumer will hold up in terms of spending?
That's the message from the market right now. When you look at consumer discretionary, you pair it up against consumer staples. So simply, what are consumers buying that they want versus need? And they're directionally positive in terms of that consumer discretionary group outperforming. That's been the case really this entire bull market. We actually put it in a ratio chart to help quantify it, and that's at record highs right now. So those consumer discretionary stocks continuing to outperform those consumer staples, and I don't see any trend change right now, especially when you look at some of the data. Again, that higher end or higher income consumer holding up very well right now and really supporting the U.S. economy.
And finally, what about putting money in America versus foreign markets? Because we do still have a White House that's idiosyncratic, let's put it that way, and unpredictable. Some investors may be giving some investors pause when it comes to owning assets in America.
I think the key to that question is really the U.S. dollar right now. And this is a conversation we're having a lot within LPL. And right now, when you look at the dollar, it's very close to breaking what we call a secular uptrend. So if we start seeing the dollar trade, the US dollar index trade below 96, that would suggest to us a regime shift away from a consolidation phase for the dollar and a resumption of this downtrend that's been in place. That is really the sign to maybe look at international as an overweight. because a weaker dollar tends to help international stocks outperform, especially emerging markets. We've already seen that this year with the MSCI Emerging Markets Index outperforming, areas like China, Mexico, Brazil starting to look very constructive. But I think you really need to wait for that dollar confirmation and wait for that breakdown from that longer term trend to really lean more into international right now. Right now, our asset allocation views are neutral around the world. So neutral US, international, developed, and emerging markets.
Adam, thanks very much indeed for joining us this morning.
Thanks for having me.
Adam Turnquist of LPL Financial.